So you do see that reaction from the markets, right? That the continuity candidate means that Jay Powell is going to be able to act more decisively when it comes to reining in inflation. What are the risks here, particularly for asset classes in Asia?
Well, certainly the risk is if inflation extends for a much more prolonged period, then the market, as I mentioned, might corner the Fed to raise rates earlier. So I think the market has already discounted a faster than expected taper and a more aggressive rate hikes. And normally, when at the very first few times of rate hikes, Asian markets will see some pressure. But if the market recognizes that it's a healthy recovery in the U.S. And corporates are able to absorb their slightly higher costs, then I think the Asian markets should stabilize thereafter.
Is inflation still the biggest concern, though, in terms of taking a look at the sectors and the companies that you prefer? Are you seeing many across the board that are looking like they can weather inflation quite well, particularly in this part of the world where it hasn't been as bad on the consumer side?
Yeah, indeed. I mean, we looked at some the management comments following the recent reporting season. A lot of them are still seeing supply constraint pressures. They're certainly seeing higher prices, input prices, whether it's cost or labor. However, in a sense, they were able to pass on some of the costs to consumers, basically because consumers' balance sheets are pretty healthy, honestly, and they're still spending, particularly in the U.S., but also in Asia. Not as strong, but still spending where they need to. So we do think corporates are able to weather this inflationary pressure for a little while longer, but not for too long.
James, of course, inflation for consumers at least not a problem as of yet for China, but they have their own issues right now. We may see some easing according to the latest from the PBOC. What are the implications for assets there?
Yeah, I think firstly, most people believe that the PBOC would not launch blanket cuts in interest rates or immediate cuts of triple Rs. I think the best they would do is targeted easing. The recent green lending tool, I think it's a perfect tool as a start to give some lending to especially the green areas and help achieve their decarbonization targets over the longer term. And we're also seeing mortgage relaxations in certain banks, and definitely probably we've seen the worst has passed in terms of the property sector. Of course, there's still volatility, but it is seemingly a bit more interesting and attractive now.
Yeah. Especially given that we really don't know what's happening with the tech sector yet, right? I mean, we have seen perhaps a lot of the regulatory crackdown seem to ease a little bit. This GTV chart on the Bloomberg showing now that some sectors of Chinese tech companies, like those with high intellectual property, is actually outperforming. So are there any parts of this sector that you like right now?
Yeah, in particular, healthcare sectors that employ a lot of technologies that are not as being in the focus in terms of the regulatory reset are some of the areas that we quite like. In general, we saw that Chinese as a broad market, we've been seeing negative earnings revisions so far this year, right? But we are seeing very, very early signs that the broad market EPS is starting to troughing. And in fact, as you mentioned, some of these tech companies were seeing very early signs of earnings revisions upwards. So I think we're maybe not too far away from a bottoming of the market. So yeah, I mean, even for our portfolios, we're almost ready to dip into the market, maybe within the next 1 to 2 months.
That's very much a tone of caution there, James. Let me get your views on the other kind of big risk for sentiment, right, which is the supply chain woes. This is our question of the day, which is really asking why are we potentially seeing a little bit of an alleviation, improvement in some supply chain measures easing. So this is pointed to things like producer prices in the US not climbing as fast as they were. Potentially, we're also seeing some chip supply seeming to have stabilised. Shipping costs are certainly coming down. That's a very clear indicator. Is this a suggestion that some of the inflation pressures are passed through? Does this bode for a better outlook, perhaps, than markets are expecting for companies?
Yeah, indeed, that's our thinking right now. I mean, for currently, firm prices should extend to the first half, but our view is, prices should start to soften in the second half. Well, basically because it is not that the companies don't want to produce, right? It's just they didn't get enough materials and inputs. But I think whether it's your upstream or downstream, as soon as your first, bulk of input is available, companies will start to rev up the production. Especially, as we all know, you're selling at much higher price today. So the law of supply demand will always be there. So my view is inflation will start to moderate as long as people get a first sign of inputs availability over the first half, and then we'll see some price softness in the second half.